It's live on LinkedIn. It's live on YouTube. And one more. I think there's a problem with Twitter for it to be live on Twitter. So, okay, so we'll go without Twitter. All right, thank you for those who are joining us. My name is Darren Joseph, HEJL Tax, which is a member of Moores Rowland Asia Pacific. We do these live streams. We try to do it every week, although as we come closer to the US tax deadline, we'll probably get a bit more delinquent, but we try to do these live streams every week. We also release video content every day on our various social media platforms, including YouTube, SoundCloud. Basically, wherever you get your podcasts, we will release new helpful content every day for you. We seek to demystify the world of cross-border tax, international tax. And today we have the honor and we have the privilege of two tax gurus who are colleagues in Moores Rowland. We have Boon Yip in Singapore and we have Ravi in KL, Malaysia. Gentlemen, would you like to introduce yourself? Boon Yip?
Hi, thank you, Darren. So my name is Boon Yip. I'm in Singapore, so I'm a partner in Moores Rowland Singapore. So I did a bit of business advisories and also tax. Yeah.
Okay, fantastic. And Ravi?
Hi, thanks, Darren. My name is Ravindra Narayanasamy. You can address me as Ravi. I'm the tax director here from Raki Siestan Ramanan. Raki Siestan Ramanan is affiliated to MARP, Asia Pacific. I mostly concentrate on tax consulting, compliance work, also international taxes. My colleagues, my partners, they're mostly involved in audits. Thanks, Darren.
Okay, fantastic. And as we always say that we are not giving tax advice. This is not meant to be tax advice. What we're doing is we're having a general conversation on general principles, which we hope would be helpful to you as you retain a tax team who is uniquely equipped to address your specific situation, right? So you need to get advice, you need to seek professional advice. We're just having a general conversation, so thanks for that. We have a number of questions that we want to go through, and we think that they will be helpful. And bear in mind that we don't think that one is better than the other. We don't think Malaysia is better than Singapore, or vice versa. We think that these are very unique jurisdictions. They happen to be close to each other, but they're unique, and they would be appropriate to different types of businesses, different types of entrepreneurs, different types of startups, right? So what we're hoping to do is kind of like tickle the imagination and help you understand what makes each jurisdiction distinct and help you as you seek to make a decision, right? So the first question is, well, both Malaysia and Singapore are described as having a territorial tax system, but this is not technically 100% true in that there are circumstances, generally speaking, where foreign derived income can be subject to tax. Comments. Let's start with Ravi. Ravi, what are your comments on that? Especially Malaysia's had quite a few changes, as I understand, within recent times. Territorial tax, Malaysia.
Yes, Darren. It's what you're saying is absolutely correct. Okay. There's been a lot of income tax cases in past year that income tax has been disputing the income remitted back to Malaysia, whether it's a Malaysian source or overseas source. There have been a lot of cases in the court cases running all these years. Most of the cases, income tax tend to lose the cases technically because there's no, clear guideline in the act to put a line, say this is, you fulfill this condition, there's no tax. If you don't fulfill, it will be taxed in Malaysia. So it's always been a gray area. So saying that also, taxpayer has been taking opportunities, I can say that also, bringing money into Malaysia without paying tax in overseas also. That means they don't pay in tax in overseas and don't pay in Malaysia. So as far as concerned over here, the law doesn't say anything that it is not taxed in overseas, it should be taxed in Malaysia. It doesn't say that. So taxpayer has been taking this as an advantage at their point. So always court case goes, all these things comes. So the point the income tax will look at it is where the work done, the job is done, where it's concluded, all these tests they will do before they conclude. Okay, so all these things are happening technically. So since this thing has been a gray area and income tax saying this is a big issue and a lot of revenue being missed out or lost for the government because of this shortfalls in the rulings. So they have changed the act since 1st January 2022. Overseas income remitted back to Malaysia is taxable in Malaysia. Is taxable based on received basis. Okay. So, however, once they came out with this ruling, there's a lot of hoo-has with the taxpayers and the general business community on this. So after that, they give some concession and they give some relaxation. One of it is for the first 6-month period from January until June, whatever amount remitted to Malaysia will be taxed at 3%. Okay. Following that period, the tax will be based on the prevailing corporate tax rate the company have to pay. Okay. Then for individuals, they have give exemption on foreign income remitted back to Malaysia on all income until 2026. This is Malaysia tax resident only. Non-resident, they can still bring money to Malaysia. It will be tax-free, still be tax-free. This is for Malaysian tax resident only. And further to that, dividend income also, this is for corporate, for dividend income, corporate dividend received from overseas is also exempted, but they have put certain condition on this. One is the baseline tax must be at least 15%. And some of the condition is now, recently they put another condition saying that the dividend that you receive from that company, they must have a substance. The company must have substance. That means that it is not a, how you say, it is not an intermediate company, yeah, without anything, just transferring the money. It must be a company in operation doing a real activity that transferring the money. So we have this issue. So as what you say, yes, the definition is a territorial tax is no longer stays. So it is going to be taxed everywhere. We have to look.
Okay, so just to quickly summarize. So the first thing is it hasn't changed. If management and control, if it's a company, or if the economic activity, if it's a person or whatever is being exercised within Malaysia, even though it's collected outside, the point is it's taxable to Malaysia, because in the situation where management and control or some sort of economic activity is being exercised from within Malaysia. Yes. However, it's in a period of transition right now where so the dividends piece, I think that's straightforward. There's a minimum tax above which, yes, it can be remitted free of charge. Otherwise, it'll be subject to tax. And then you have the idea that if it's a shell company, that doesn't count. Yes. It has to be real substance, economic substance in some of the jurisdiction for the dividends to come in. Now, in terms of other types of remitted income, it will be subject to tax, but it's going to be phased in over a period of time. Okay. Yes. So right now we're looking at 3%, but eventually by 2026, it will be whatever the prevailing corporate tax rate is, which roughly is around 25%.
Yes. The other thing, Darren, when Boon Yip's reply this also, I just want to just clarify, Boon Yip to clarify, because what I heard is Malaysia currently is their remittance basis is purely based on remittance basis. Okay. I heard Singapore, they also have a provision of set off. That means you don't, in Malaysia, the money must actually come to Malaysia, then only you tax it. Crediting the amount, knocking off with accounts is not counted as for tax. But Singapore does have that provision saying that also is counted. I'm not sure.
Boon Yip?
Yeah, okay. Generally, Singapore and Malaysia, the tax system is based on UK, so they share almost the same principles. But I would think Singapore is a lot easier. So in terms of foreign source income, there are three categories that you can have tax exemption. There's a dividend, foreign source dividend, service income, and also branch profits, right? So what happened is, obviously you have to satisfy criteria. So there are three criteria that you have to satisfy. So being taxed already in the overseas jurisdiction, and of course the headline tax must be 15%, and also the controller has to be satisfied that is not at the expense of the Singapore tax, right? So the taxpayer, I mean, so these are the main criteria, the three main criteria that you have to meet, all of them, in order to have those income exempted from tax. I think it's fair and equitable, because if you look at the basis of Singapore is, they always say that you wouldn't be taxed twice, right? So say, for instance, dividend is always first year. So you will not tax you another time unless the dividend has not suffered any tax in overseas. So which is why you must first suffer the tax, and the headline tax has to be 15%. And nowadays, I think 15% you would hit all jurisdiction except tax haven, right? So I think this part is very clear in Singapore. But there's a gray area also. I mean, I personally feel that often I had an inquiry from clients. Back then, I think 2 weeks ago, I had one. They were asking, if I set up a company in Singapore, but all my trades, all the management control, everything else is offshore. So nothing except Singapore company. Even the bank account is not in Singapore. So do I exempt from tax? The answer is no. Okay, it's no, because they are in trade. So actually, it's a real company. So what happened is this group of people, they are from Australia. So they are thinking to do some restructuring. Obviously, they are not thinking to evade tax or what. Primarily, it's just to consider Singapore jurisdiction. But they heard about if you have a Singapore company with everything else offshore, means you don't have to suffer any tax. But that's not true. Okay, that's not true.
That's not true. And that's an important point. I'm glad you raised it, because I mean, I don't want to call their name, but there's another big service provider with a very strong online presence based in Singapore that has been selling that online. So what they've advocated is, if there's no bank, there's no economic substance in Singapore, then the company is zero. That they've said this online, but you're saying that this may not be technically true sometimes.
Yes, as long as they are in trade, okay. So it's definitely subject to tax. But there may be somehow a twist. So depending on how they sell it. So it could be service income. They were in service industry, and it's foreign source. Yes, probably yes. You may not subject to tax in Singapore. So I don't know how they sell it, but if you are in trade, a Singapore company, definitely you suffer a corporate tax.
Okay, understood. So just to kind of summarize, you're correct. So the regime, so both, as correctly pointed out, in terms of the heritage, both derive from UK Company Law, Company Act. So they both have the principle of management and control, first and foremost, and they all have the idea of the remittance basis of taxation, except that there are fewer exceptions for Singapore, and there are perhaps more exceptions for Malaysia. So in Singapore, it's absolutely sacrosanct. Dividends are tax-free, provided they've been taxed elsewhere, minimum 15%. But again, other remittances, they will be free of tax, provided they've been taxed somewhere else, right? And of course, proper transfer pricing, if it's a related party transaction as well.
Yeah.
Right.
Irrespective of whether you remit, but if you are in trade, it's subject to tax.
Okay. Yeah. Okay. Right. Gotcha. Okay. Thank you very much for that. Let's move on to the next one. Oh, the corporate tax rate. Yes. So yeah, again, this might be a straightforward question, but I know that there tends to be, a little bit of exceptions to it. So I'll start with you, Bunya. What is the corporate tax rate in Singapore? But how could it be modified? What opportunities are there for reducing that rate?
Okay, so the headline tax is 70%. So I don't think that would get any lower. It's considered quite low in the region. So I don't think the government will get any lower. But in Singapore, you have something called the tax exemption. So effectively, I would say most of the companies, most of the SME would not hit 17%. Okay, would not hit 70%. So it can be as low as, I think it's, let me check, it's as low as effectively is 4.25%. Yeah, so it's really low. So you're talking about if you have 100,000 of chargeable income, you're talking about 4.25% of tax effectively.
How does that work? I mean, not the details, but how is it that it's come all the way down from 17 to 4?
So they have something like a relief. Okay, so if you had that relief taken away, so effectively you are paying a smaller amount of tax. So that works out to be 4.25%.
Right. And is there a threshold? So you mentioned SME, so your turnover has to be below what income?
Oh, no, it doesn't track by turnover. So as long as you have chargeable income, you get tax exempted on a certain level.
Right. So chargeable income up to 100,000.
Yes. Let me see. If I'm not mistaken, 100,000 you get some. You get 50% off 100,000, something like that. But I don't remember quite correctly.
Okay. So, and just to be clear again, for those who may be listening, when we say chargeable income, we mean taxable income. So earnings after expenses. That is okay. Yes. Gotcha. Okay, so 4% sounds pretty attractive. Malaysia, Ravi.
Yeah. Okay. For Malaysia, the corporate tax, there's 2 tiers. One is for the non-SME companies. Non-SME companies, basically their paid up capital is less than 2.5 million. Okay, for the less than 2.5 million, for the first 600K, their tax rate is 17%. The rest of it will fall 24%. For non-SME, that is paid up capital above 2.5 million, or whatever income they receive is at flat 24%, technically. So,
but
I'm not sure.
I'm waiting for but there's Labuan, right?
Yeah, there's Labuan. Labuan is getting more stricter. That means the rules are more tighter because of the BIPS conditions they put into Malaysia. Labuan also, there's 2 things. One is Labuan business activity. Labuan business activity, you comply to the substance. If you comply to the substance, actually the substance depends on what kind of industry. Certain industry, they have a different substance. Okay, this industry, they maybe say your substance, you must have you must have an office, so much of expenses. You have 1 staff, your operating expenditure so much. Then different nature of business, different requirement. So it's based on the substance. If you fulfill the substance means, then it will be taxed at 3% on the net profit. Okay, on the accounts. That is it. Okay. If you don't comply with the substance, then you go for 24%. Okay. Last time there was before this act changes, they told that those Labuan company didn't comply to the substance, they must report the income tax under the Income Tax Act, not the Labuan Act. There was a lot of against on this because the business committee didn't agree, because they have physically the arrangement has been done, all these things. You cannot really overnight change this. That's why they have this flexibility. They say you still can be a Labuan tax, but you pay 24% tax. Okay, so since they are still in Labuan, there is still benefit for them because they don't still submit the tax estimate form. A few of the conditions that apply under the Income Tax Act, they no need to follow. They still follow the Labuan tax rule. I see a bit relaxed, but the thing is, Labuan, although the tax is low, but the penalties are quite high compared to Income Tax Act. So one of our clients, I think 3 years back, is we are not doing that company, Ashford, because they have many companies under the group. The tax agent is a different tax agent. So they was rushing and they couldn't make the deadline and submitted. I think that just the submission, the late submission fee come around $500,000. It's quite, and it's very difficult. We heard it's a difficult task to go and appeal with Labuan. Although that's why I see they are giving this kind of concession, but they're catching you with this. So you must really see whether the company, some of them are moving out already from Labuan because of this. They couldn't comply with these requirements, you see. Then, okay, the other one is non-business activity, Labuan non-business activity, like investment holding. Same thing also, that's the second tier. If they comply with the substance, zero tax.
Wow.
Zero tax.
Yeah.
If they doesn't comply with the substance, same problem, 24% tax.
Okay. So it's super important to get advice from reputable, qualified tax teams to make sure that whatever it is you're doing is in compliance with the Labuan Act, assuming that's your preferred route.
Yes.
Okay.
Yes.
Whereas in Singapore, the 4%, there are a few caveats for 4%. And Boon Yip, if I understood what you said earlier, there may not even be a substance requirement. The private limited, is there a requirement for companies to have economic substance in Singapore?
I think probably the lowest, is 4.25%, but you have conditions. So what happened is to enjoy that kind of tax exemption, there's a shareholders requirement, I think. Okay, I think it's 30% has to be individual, need not be local, it can be a foreigner. So if you have those 100% own corporate shareholders, you may not enjoy 4.25%, but you still enjoy a lower effective tax. I couldn't remember how much, but definitely it's not much. I think probably 5-6%. So it's not far away.
Okay, so the requirement is for individual shareholders, but what about economic substance? Is there any substance requirements for Singapore?
Okay, basically these are trades. Okay, so companies that are involved in trades. So trades as in you provide service is considered trade. So you sell goods, right? So as long as you are in trades, they allow you these exemptions.
Right. So in other words, no holding companies, no investment companies.
Yes, correct. So holding companies are not entitled, but they don't get the full tax exemptions, which gets to as low as 4.25%, but they still get the partial, which is I think probably 7-8%.
Okay, gotcha. Thank you very much for that. Next question. Right, some jurisdictions, for example, the United States, right? There you do get double tax in the sense that the company pays taxes at the corporate tax rate for C Corp right now is 21%. And then when the shareholder receives the dividends, that's going to be taxed at whatever the ordinary tax rates are. Well, if it's qualified dividends, it's going to be 15 or 20%. So that's what the individual will pay or the shareholder would pay, right? I think you made it clear, Boon Yip, that for Singapore, there is no tax on dividends, except where the dividends arise from outside and remitted into Singapore, and they have not been taxed. At least the corporation that generated those dividends has not been taxed. Am I correct in saying that?
Yeah. So if it has been taxed overseas, there isn't any more tax in Singapore, but that is just provided it is tax besides cooperation. So I think there's some kind of cooperate in Singapore, like the union they do give up dividend. So I'm a union member. So they give up dividend, but it's taxed in Singapore.
Mm.
I get
Okay.
taxed from
So,
union.
okay. So just to be clear, it's not just the corporation that generated the dividend, but the dividend itself must have been taxed from
Yes.
whatever jurisdiction it was in before it comes back to Singapore.
Yeah,
Then it'll
correct.
be taxed to Singapore.
Yeah.
Understood. Understood. So there is double tax on dividends that arises from outside of Singapore, but not domestic dividends.
Domestic dividend, you don't get tax. Most of the domestic dividend, you don't get tax except the union. As I said, there isn't many union here in Singapore. So
Union as in what type of union? Like
okay,
trade union?
the one that I had was is trade union. It's
Right.
called cooperative, something like that. So I get dividend every year, being a member, but I have to pay tax for that.
Okay. So, okay, that's a special entity.
Yeah. Yes.
So it's not a private limited, it's something else.
No,
Okay.
it's not. Yeah. It's cooperative.
Gotcha.
Cooperative.
Right. And Ravi, Malaysia, yes. It sounds like it's more yes than no. Is it?
Yeah. Now, I can say, safely can say most of the dividend, Malaysian dividend are tax exempted because it's,
Okay.
we go on single tier basis. As long as the corporate has been taxed, then they pay from the single tier account, then it's exempted, or it's from their exempt account. It's exempted. But companies must be careful whether they're receiving dividends from BVI company from Labuan.
Yeah.
Because Labuan, as I told you, is tax-free. Okay. But some of the BVI company, they pay to Labuan, then Labuan distribute the dividend back to Malaysia. That one will be taxable.
Because, okay, so it sees through the Labuan and looks at the
Because as you
underlying
told,
entity.
because no, it's a shelf company technically.
Oh, right. Went back to the shell company rule.
Yeah.
So, okay, so the companies, just so I understand it, so the company that generates the dividend must have been taxed.
Yes, yes.
It's not necessary that the dividend has been taxed, but the company must have borne a tax burden wherever it is.
Yes, yes.
So is there any minimum tax? So, for example, Labuan 3%. There are other
at the moment,
islands.
from Labuan, there's no I don't see any conditions coming in from Labuan because as long as Labuan pays, it says the other side is tax means is okay because they have a different jurisdiction totally from the Income Tax Act over here.
Right. And there are other jurisdictions that will give you 1% corporate tax. So if it's been taxed at 1% somewhere else, the dividends will still be tax-free to Malaysia, right?
Yes.
Right. So, in that sense,
sorry, they just want to ensure it's not a shell company. That means they're not shifting the profit here. That's all. So at least this is tax. Any percentage, I think. This for Labuan only, yeah.
Okay. So that could be quite interesting. So if it is someone has some sort of interest in a company outside of Singapore, Malaysia, and the company is in a low tax jurisdiction, is not a shell company in their substance, right? Then it would be perhaps to someone's advantage to be in Malaysia as opposed to be Singapore, because Singapore will want the dividends to have been taxed elsewhere, whereas Malaysia is saying it's fine. Once the company has been taxed and there's real substance, you can get the dividends tax-free. Am I correct in saying that?
No, that one, as I told you, that one is applied for Labuan only. If
for
Labuan, that means the dividend is coming through. They're using Labuan as an intermediate company to pay to a Malaysian company here. If a normal from overseas coming back to here, same as what Boon Yip had said, the same thing. It will be taxed. It will be taxed if doesn't qualify for the headline tax, 15%.
Right. Okay. Right. Okay. So the company must have been taxed at 15% minimum, and there must be substance as well, right?
Yes. Correct.
Right. But the difference from what Boon Yip is saying, if I'm understanding it correctly, is that Singapore is saying the company should have been taxed and the dividends should have been taxed elsewhere to come in. Whereas Malaysia is saying the company should have been taxed.
For Malaysia, it's saying the dividend must be taxed. The company must have a substance. It didn't say the company must be taxed.
Oh, I see. The dividend must be taxed. Right. Okay.
Yeah.
Okay.
The company must have a substance.
Right. And the dividend must have been taxed at a minimum of
15%.
Is there any minimum? 15%.
15%.
Okay,
But
so
anyway,
both.
you're talking about that also. You still get the unilateral and bilateral credit when you calculate the tax. You can still knock off with that figures.
So you get so you get tax credits for the tax that has been paid outside,
Yes.
right? But that'll be deductible against ordinary income or passive income as well. How would you? What benefit is that to you as a Malaysian tax resident if you get credits for taxes paid on those dividends outside?
You don't pay double tax.
Right. Okay.
You
Well,
don't pay.
but then dividends are tax free in Malaysia anyway, right?
For Malaysia, no. Yeah, correct. That means the
Yeah,
dividend paid by
yeah.
Malaysian company is tax free. Yes, yes, correct. Wow,
Yeah.
sorry. Yeah.
Okay. All right. So, in other words, okay. So then I'll revise my conclusion. Singapore and Malaysia are probably the same
Yeah.
in terms of
Yeah.
Okay.
Yeah.
Gotcha.
But I
Understood.
remember the last time Malaysia still have the non-first year dividend, right? So do they still have currently?
No.
Right? No more. Okay.
No.
Right.
That one, that time is on the when we have the section 108.
Oh, okay.
Declaring that time, but now it's all consistent single tier. The rule change. There's no more.
No more. All right.
Yeah.
Okay.
So we can move from corporate to personal. So question is, what are the personal income tax rates? Generally speaking, I guess obviously the tiers, but I guess we're looking for planning opportunities when it comes to receiving income from outside. So personal income tax, Ravi, what are the ranges and what opportunities there are there?
Personal income tax at the moment, the minimum
Mhm.
is of course starts from 1% for the first, after the first 5,000. Okay,
Mhm.
technically, then the maximum is 30% for
Mm.
the above 2 million. So it is quite high, you can say.
Mm.
That is for tax resident. It's based on scale rate. Tax resident, you need to be 182 days in Malaysia to qualify. Then that's the minimum requirement. Then there are a few acts that you can check also whether you're qualified or not, because you can see 2-3 years or so there's a calculation to be seen. But in basic, you must be 182 days in Malaysia to qualify. If you're non-resident, then you will be taxed at 30% flat rate without any relief, no tax relief.
Okay, so 1 to 30% for Malaysian tax resident. Now, we spoke about dividends, so we don't need to talk about that. What about other remittances? So if somebody has royalties, interest, income, would all that be taxable as well, unless it was taxed somewhere else?
No, because we have under the DTA also you have this, we also have it. We call it special classes of income. Okay, that goes under withholding tax. Interest at the moment is 15% withholding tax. Like Singapore and Malaysia, they have a DTA. Singapore, Malaysia is 10%. Okay, so they give a reduced rate. Okay, then you have.
Right. But if it is that the income is being remitted or received from a jurisdiction without a DTA with Malaysia,
then it's go 15%.
That'll be 15% across the board.
15%. You follow that. You fall back to the Malaysian Income Tax Act. If the DTA giving a lower rate means you'll fall back to the DTA.
Okay, understood.
Okay. Then you have technical fees. Technical fees is normally 10%. Okay, then you have royalties. Royalties also you have 10%. Then you have what do you say? Contractors. Consultant and contractor. That means you are in Malaysia more than 6 months. You're doing some projects or what, then that will be on 10 plus 3. 10 plus 3 means 10 for the company, another 3 for the employees that you are bringing outside Malaysia to work here. Because this money normally they have 10 plus 3 because they assume this company will need to do a tax return at end of the project because their PE presence is more than 6 months. Okay, so when they do the return, if there is any making a loss or anything, they can get the refund. If they are making more profit, then they have to pay a higher tax based on the corporate rate.
Like 24%. Gotcha.
Yeah.
Okay.
24%.
Okay. Boon Yip, individual taxes?
Okay.
Singapore.
Are you saying withholding tax or personal tax?
Personal tax, individual.
Okay.
Yeah.
Understand. Right. So personal tax in Singapore, I think it's quite a big spread. So you're talking about the lowest at 2%, up to the highest of 24%. So they really tax the rich one. So if you are earning like 240,000 a year, you could be end up paying close to 20%. So it's quite high. So 20% is quite high. Okay, normal mid-income, we will end up like between 6 to 12%, something like that. So most of us would hit that bracket, right? So, but unfortunately, Singapore government gives support a lot SME, corporate tax in terms of corporate, but very little to the personal. So there isn't a lot of incentives for personnel. So whatever you earn, most of them get taxed.
Okay. And what about income arising outside? We spoke about dividends already, but what about someone getting interest, royalties, some sort of passive income, maybe rental income from outside?
So interest is not taxable. So like what Ravi says, so if you receive royalty, everything else, you'll probably get taxed outside, right?
Okay,
So,
but not by Singapore.
Yeah, you are not a trade, so you probably suffer tax and you will not be considered.
Okay, whereas Malaysia is going to tax you on that passive income that you receive from outside. Okay, understood. And Ravi, does it apply to rental income? So like if I'm living in KL and I have lots of rental properties in Hong Kong and Singapore, and that the rent comes into me in KL, am I going to be taxed on that as well?
No, because income tax fall on, you're talking about individuals, huh? Not
individuals, yeah. An individual, correct.
Okay, individuals. Because you see, income tax, normally you have to fall under the section 4 of the income tax. Section 4, you have A, B, C, D, E, F. Okay, you must fall. Rental is one of it, but the rental, it says that it must be territorial based, as I told you. The rental must be from Malaysia. Okay, overseas income remitted back to Malaysia is taxable, as I told you, but you want to tax the overseas Malaysia remitted back to tax, the income must fall, still must fall under the 4A, must be within the 4A. So we have one under withholding tax clause, say income of movable properties. Okay, maybe you rent a ship, means yes. That means there will be taxable withholding tax on it. You're receiving it. You have to receive withholding tax when you make the payment. But for these properties, there's no tax technically for overseas. That means you remit the money, it won't fall under the section 4A.
Right. Okay. So that's good. But other classes of income,
because technically you have suffered tax also in overseas.
Okay. But the others that we discussed, so royalties, interest, that'll all be still taxable, even though it's coming from overseas.
Yes.
Okay. Gotcha. Okay.
So in Singapore, if you have overseas income that is suffered tax in, let's say, Australia, when you receive it in Singapore, you don't even need to declare. So that's the thing. So it's quite clear. So whatever taxable, they are like rental, yes, it's taxable. Trades, property, investment, yes. Okay, stock options also the other one that is taxable.
Okay, thank you. So we'll actually that takes us to our next question. Let's talk about stock options, right? I've seen in some spaces it's discussed and termed an exit tax for Singapore. If it is you're working in Singapore and you had options with whatever company is popular with technology companies especially, and then your employment pass is surrendered and you're leaving Singapore permanently, there's a deemed exercise rule. So you're deemed to exercise those options even though you have not. And so that's considered an exit tax of sorts. Are there any other exit taxes of that nature that applies to Singapore?
Oh, yeah. So Singapore has this deemed exercise rule. So generally, stock option is only taxable when you exercise. So this exception when is where deemed exercise rule applies. So when you cease employment, and there are essentially 4 types. Okay, we split it into 2. One is stock options, one is share awards. So share awards are normally given to you free, as in like the company gives you shares. Options you definitely have to exercise. So unexercised stock options, okay, the 4 types are unexercised stock options, restricted stock options, which are those shares under a moratorium, okay, and unvested share award, and also restricted share award under moratorium. So these are the 4 types, right? So it's deemed exercisable.
Okay. Any other exit taxes that may apply when someone is leaving Singapore, or is that about it?
Yes, for stock options, that is essentially the 4 types of stocks that attracted the deemed exercise rule.
Understood. Ravi, what about Malaysia? Are there any other taxes that that happen or that are triggered when someone is leaving Malaysia permanently, like when they give up their EP?
Okay, before I answer this question, I just strike my mind before the question going back again. The individual tax you're asking, right? For the rental. Actually, we don't need to worry about individual tax remitted back to from overseas, because I told you from the beginning, because it's exempted until 2026.
Right.
So,
yeah.
So we expecting it. They should extend it, I think so. Because the thing is, a lot of people like Malaysian working in Singapore also. You see, they're going every day, come back. So there are a lot of technical issues. I think they want to iron out all these issues before they want to make it. So at this moment, I can say it's no tax. Not to say rental also. Whatever individual remit back from overseas, it should be tax exempt.
Okay, understood.
Until 2026. Okay, exit tax. You're talking about exit tax. There's no such exit tax in Malaysia. But you're talking about exit means like a company is exiting from Malaysia, or the individual is exiting from Malaysia. You're referring for that kind of thing, right? Yeah, moving on. So if that is the case,
in this case, an individual. So we're playing the scenario of an individual. They're giving up their employment pass and they're leaving. Yeah.
They only need to do a tax clearance. That means, okay, they need to do tax clearance. That's all. That means they have to upfront submit to the income tax within 30 days from your resignation date. Actually, let's say you're resigning in 30 January, means you must submit by December before that month, 1 month earlier. Then you must clear before you leave Malaysia. You must get the clearance. Then only you leave Malaysia. That's only that.
Right. So there are no like deemed exercise rules when it comes to restricted stock or options. Nothing like that. Okay.
No such thing. If in the event the employee failed to pay or clear the tax, the employer will have to take the risk paying the taxes. They will go after the employer because it's in the act.
Yeah. Gotcha. Okay, that's good to know. Moving on to the next question. Right. The next question is about indirect taxes. So what some people, because when people think about, do I move to one jurisdiction or the other, they always focus on the direct taxes, the corporate tax, personal income tax, but sometimes they don't forget the indirect taxes can be also very important. So the GST, the VAT, sales tax, service tax. So in terms of GST, how much is it in Singapore and what is the threshold?
Oh, okay. Singapore, bad news. So from this year, raised GST from 7 to 8%. And from 1st of January 2024, it will be at 9%. So yes, it's 9% upcoming, and currently it's at 8%. So threshold, okay, so 1 million is the threshold. So if you are in trade, so if you don't have 1 million of revenue, you need not register for GST. But generally speaking, given the rise in GST and upcoming 9%, there's an incentive to register for GST even if your revenue doesn't hit the mandatory level, right? So reason being because you may incur input tax. So
Right. To get the refunds. Yeah.
yeah, right, exactly. So you're talking about rentals has all raised, right? So GST could be very high on the rental. So it makes sense for you to register for GST.
Okay. So 7 going to 8%, 1 million threshold.
Yeah, 1
Ravi,
million Singapore dollars. Sorry,
1 million?
Singapore dollars.
Yeah, Singapore dollars. Yeah. And Ravi, what about Malaysia?
Oh, Malaysia, GST is history at the moment. So we came back to SST, sales and service tax.
Yeah.
Generally, the threshold is 500K. Sorry. Generally, the threshold is 500K.
Okay. And how much is it? What is the amount?
6%.
6%.
6%. So we
low.
wait and see next week whether they're increasing or not.
Right. Budget next week. Okay.
Yeah, budget.
6%. Okay. And what about, is there the equivalent of a Netflix tax and digital services? So basically, if it is that you're a technology company, presumably with no permanent establishment in Malaysia, Malaysia, but they are providing services to customers or clients in Malaysia, would they be taxed? If so, how and how much?
Okay. This is called as digital tax, technically.
Right.
Okay. As I told you, GST is not coming back. So they have to look on SST and expand it where they can to make more revenue. Okay. So one of it, what you say is recently, I think it's 2020, not mistaken, there was they implemented this foreign service provider, FSP, digital foreign service provider, need to register for SST, for any digital services provided in Malaysia, if your threshold reaches 500K per annum. Okay, it's compulsory. That means the company is not registered in Malaysia, but you're from overseas, you're doing business with Malaysia, you need to register. So this Netflix all fall under that category, and they have to register. The rate still same 6%.
Okay. Now, so that's with a technology company like a streaming platform. But what about a service provider? If there's a consultant sitting in Singapore and providing consulting services online to clients in KL or Penang, would that SST apply to them as well?
Yeah, because we have another clause also, imported services tax. Okay? Because you see, if initially there was no, when they introduced the service tax, there is no such thing. Then they find out that a lot of companies are getting advice from overseas rather than from Malaysia, because they have to pay this 6% extra. Okay, because you go for Singapore, elsewhere means you don't pay the 6%. So so they say based on that, they amend the act. They say if you are getting the services from overseas, it's related to your business in Malaysia or anything to do your sales, your good related in Malaysia, you have to top up 6% and you pay to the customs. Okay, that means you pay 100% there, but you top up another 6%. That means they may have to take it out from your own pocket, the 6%, and pay to the customs. So their responsibility falls on the payer.
Yes.
Rather than the service provider, because the service provider is not registered. That's why they have to come out with such a rule.
You're right. And so I imagine that'll be easy to police if it's a corporate customer, because then they want to deduct the expenses on their income statement, right? So then, so there's a built-in incentive to comply. Whereas if suppose the service provider in Singapore, wherever, is providing it to individuals in Malaysia, not to companies in Malaysia.
Yeah.
How does it work there?
Individual, no, it's for business only, the service tax, technically.
Okay, right. Okay, gotcha. Perfect. Understood. And let's switch over to Singapore.
Okay, Singapore has some similarity with Malaysia in terms of digital tax. And obviously, since 2020, I think, Singapore started the digital tax. So I still remember in the past, I subscribed something from the web, the domain like that, I don't see the GST thing coming up. But
Mhm.
I mean, since then, since 2020, I saw, right, GST.
Mhm.
So that answer the question. For overseas vendor, like I remember subscribing from an Australian vendor. So
Mm.
they don't have any establishment here. So, but
Mhm.
the invoice that I get is now GST. So what happened is that means they actually register for GST. In fact, we did
Mhm.
what happened. A very good case to showcase is one of the university. In fact, we have a few universities client
Mhm.
from.
Mhm.
So what happens is during COVID, they do a lot of online courses and
Yeah.
also university courses over on the web. I
Right.
mean, webinar by web. So yeah, they just get us to register
Mhm.
GST because they are OC vendor that provide
Mhm.
service in Singapore, right?
Mhm.
So this is a very good example. So yes, for that, there's one more rule just applying in effect this year, 2023. So what happened is this I think is the overseas vendor scheme, something like that. Okay,
Mm.
so what happened is if you are not a GST register, essentially if let's say I'm a company but I'm not GST registered, I procure service from overseas, so imported service like what Ravi says.
Mhm.
So
Mhm.
I have to actually do a reverse charge GST. So
Mm.
to say, let's say I buy a 10,000 goods, I will have to
Mhm.
add 8%, $800 on top of that, and I
Mhm.
pay GST to the government. But if I'm a GST registrant, so there is no meaning to do that because eventually I will claim back my input tax. So there's
Mhm.
no need
Mhm.
to do that. So this will affect those non-GST registrant, which is why
Mhm.
I said it makes sense to register for GST.
Is there any de minimis? Is there any minimum or the
I think
first? Mhm.
yes. The threshold is still the same, but I think for the
Okay.
OC vendor piece is down to 100,000, something like that. Yeah.
Okay. So if you procure services from outside of Singapore, that is 100,000 Sing or more, you need to add GST to that.
No, you have to charge GST for now. Yeah. But
Okay.
I think the overseas vendor scheme is the threshold is if you do make a B2C supplies or
Mm.
low-value goods and remote services, such
Mhm.
like digital services, then
Mhm.
to Singapore exceeding 100,000. Okay, the threshold
Mhm.
is 100,000, and obviously your global turnover is what, 1 million. Then you have to
Right.
get yourself registered. That is the OVR regime.
Okay. So it will be so the 1 million threshold still applies. So if your turnover is less than 1 million, you don't need to worry about the overseas registration.
Yes. So if you are overseas vendor, let's say if
Yeah.
I'm an overseas vendor,
Mhm.
my turnover globally is 1 million, and
Yes.
I do supplies to Singapore.
Singapore. Mhm.
Yeah, let's say Singapore domain.
Mhm. Mhm.
For exceeding 100,000, then I have to do that.
Right. Okay. Crystal clear. Gotcha. Thank you very much. So next question is about mandatory audits. So I think Hong Kong is kind of popular in our neighborhood where any company at all needs to have an audit every year. But in Malaysia and Singapore, I think there would be thresholds. Ravi, what is a threshold for requiring an audit for a company in Malaysia?
Generally, all corporation need to be audited.
Oh, it's all.
Okay,
Okay.
all,
Yeah.
but only
Yeah.
they have given 3 categories exemption. Other than this category, all
Yeah.
companies need to be audited. One
Right.
is dormant company. Dormant since incorporation, and
Mhm.
current year also is dormant. Okay, but
Mhm.
for some reason, from my experience, the company is still auditing these companies. Okay, they
Okay.
don't want to get some exemption. They want, because you see, like banks or
Mhm.
certain companies, they ask for all financial statement. They prefer to have an auditor report rather than just
Mhm.
giving them a P&L or management account. That's I can
Mhm.
see that. The other
Mhm.
category is zero revenue company. Zero
Mhm.
revenue company means that the company does not have any revenue. Current, let's say
Mhm.
current year we're going to audit. For the past
Yeah.
2 years also, they have no revenue. At same time, their current asset doesn't exceed 300K for all the 3 years. Okay, that was the second category. Then the
so
third
that'll be like an investment holding company. So
investment holding companies are normally
or just
the threshold will go above that.
okay,
buy
so
one
like
property, depends.
right, okay.
Depends. You can say
Okay,
it's
sorry.
a small family company means yes, maybe yes. If a big holding company with their subsidiaries is normally, from my experience, it will go above that. Some of the companies, most of the dormant companies, they only have assets in the balance sheet, but the P&L is zero. They have investment over there, over here. That's you can see, because they like to park the properties in these companies for future use, technically.
Okay, understand.
Okay, for the third category is threshold qualified companies, we call it. The revenue not exceeding 100,000 in current or 2 preceding years. And the same thing, the asset not going above 300K for the past current year and the past 2 years.
Okay. So basically very small companies, and it's 100,000 ringgit. Okay.
Yes.
Right. So then you can say the lowest one will be 100,000 ringgit. So if you're more than 100,000, you're probably going to have to think about audits, right?
Yeah, correct.
Gotcha. And Singapore, Boon Yip?
Okay, Singapore is quite straightforward. So it go by threshold. So essentially, all companies can have audit exemptions besides a public interest company, where you meet 2 out of 3 of the threshold, being 50 headcounts, as in staff, 10 million Singapore dollars of total assets, and $10 million Singapore dollars of revenue. So if you hit 2 out of 3 over the 2 financial year, consecutive financial year, you have to do audit, meaning you don't get exemptions. Yeah.
Okay, 10 million. So definitely Malaysia is a much lower audit threshold than Singapore.
Yeah.
Okay.
Yes.
Understood. I want to talk about employment passes, and this is quite interesting because I know Singapore has had some changes recently. But generally speaking, for someone, you started a company and you want to bring in professional staff from outside of the jurisdiction, what is the threshold in Singapore, generally speaking? I know it's unique to industry and stuff like that, but generally speaking.
Okay, Singapore has a few passes. So the most popular being the E-Pass and the S-Pass, employment pass and the S-Pass. So employment pass is a lot for professionals. So for PMET, they name it PMET. So that is at least $5,000 a month, Singapore dollars a month, to get employment pass. But it also depends on nationality. So it doesn't mean that if you pay someone $5,000, you'll get an employment pass straight away. So it very much depends on the nationality, obviously, right? So S-Pass, on the other hand.
Sorry, and just to clarify, PMET, professionals, managers, executives, and technicians?
Technicians, yeah, yes.
Oh, okay, right.
Right.
Okay.
So on the other hand, S-Pass is for skilled workers, skilled and semi-skilled worker, a lot lower. So the requirement is at least 3,000 a month. You can get the S-Pass. So S-Pass, definitely that works on quota. So quota basis. So if you have a lot, let's say if you recruit local citizens, being PR or Singapore citizens, it goes by quota. So for our industry, like accountancy, if I'm not mistaken, I think it's 7-1. So every 7 locals that I hire, I get to hire one work permit pass.
S-Pass.
One S-Pass. One work permit pass. Yeah. But S-Pass, you can hire, but it's subject to levy. Yeah, subject to levy. Yes.
Oh, okay, great. Ravi?
Yeah. Malaysia, as what Singapore has also, we have for professionals employment pass. We have for employment pass category, we have 2 categories here. one is the basic minimum salary is 10,000. That's the first year. Okay, the employment contract can be up to 5 years. Okay, the maximum. Then you, under this category, dependent pass is allowed. Okay, so the minimum, let's say, is a foreign-owned company, means the paid-up capital must be at least 500K. That is the paid-up minimum paid-up capital 500K. Then the second,
and it must be in a Malaysian bank.
Yes.
Liquid 500K liquid in them. Okay, right.
Yes, yes. So oh look, they say paid up capital 500K. It's not to say a liquid cash 500. They can have asset also. Technically, the auditors know how to work out this 500. But technically speaking, if a new company means, of course, it's going to be based on the liquid. If a long-term company means maybe they already have an asset or something, it can be part of the paid up capital. It's not an issue as long as it's part of the paid up. Okay. Then the second category is minimum salary is 5,000, maximum to 999. That's the second category there. Second category, the employment pass you have for 2 years. You can do a contract up to 2 years. You can get a dependent pass on this also. Same paid up capital 500K. The other question, if let's say the directors, the company directors himself is a foreigner, he want to apply for this thing, the paid up capital must be at 1 million. So that is a bit more. You must have a 1 million paid up capital there. So the other thing is now all these are under online. We have to apply online. That means you have to register before you apply the EP itself. You must register the company first. The company who's applying the EP will apply themselves online. It is not through the agent nowadays. Maybe what the agent will do, the agent will register the company there. Then they will use the company's login to apply the function. That's how the system runs at the moment.
Just like Singapore. Okay, understood.
Right.
Okay, gotcha. And Singapore also has the dependent pass, which is attached to the employment pass. But one change that has been recent in the past few years, is that the dependent pass used to be able to work once there's a letter of consent, but I believe that's no longer the case. So if someone is on a dependent pass and they need to work, they need to get an EP themselves. What about in Malaysia? If someone is on a dependent pass attached to an employment pass, can they work, or would they need to apply for an employment pass? Okay,
they couldn't work. They have to surrender and apply for it.
Okay, same. I could see in many ways Singapore and Malaysia move in lockstep with each other. Okay. Connected to the idea of an employment pass, it used to be relatively common for an entrepreneur to create a company and have that company apply for their employment pass. You know, at least when I arrived in Singapore like 10 years ago, it was not easy, but it was possible. But progressively, it's becoming more and more difficult for that to happen in Singapore. Am I correct in saying that, Boon Yip? Well, how does it work for that entrepreneur? They have a startup, they have an idea. Are they able to create a company on their own and then that company give them an EP?
Yeah. I mean, you're absolutely right. So definitely yes, but it's getting a lot harder these days. Okay, reason being is the government tried to avoid phantom EP. Okay.
Yeah.
So in a way, you take up the quota. You don't really belong in Singapore, and it's not fair to others, right? So that's the whole idea. Okay, that I see. But obviously now, if a foreigner would really start a company and stay in Singapore to work, have to submit a business plan, right? The recruitment plan, things like that. What's the, short-term plan, 3 to 5 years plan, what you plan to do in Singapore with the company? Will you bring your family? Things like that. So all in all, these are important characteristics for the government, as in for the Manpower Ministry, to consider whether to grant you an employment pass.
Okay. And what about Malaysia? Is that possible?
Yes, as possible. As what I told earlier, as just what Boon Yip also say, you must incorporate the company first to apply. Then your paid up capital must be 1 million. Okay. Then as what Boon Yip say, you must get the government's approval. It's not they simply won't give you apply. Also they won't give. It's because certain industries like trade industries, you're doing trading, all this. They want to protect the local industry. So they want to see whether which one you can enter, which one you cannot enter. They will decide. So there's conditions, license to apply. You must fulfill all these things before you can proceed for the EP.
Okay, great. Okay, so those are the questions that we have. Now, if we step back, I mean, obviously I've been in the neighborhood for 10 years and you guys have lived there all your lives, right? So what are your thoughts like for what is the ideal type of entrepreneur that Singapore is more appropriate for versus Malaysia? Where's the right fit? Ravi, let's start with you. Who do you think would be better suited to Malaysia as opposed to Singapore, generally speaking?
Generally speaking, I think Malaysia is still, the labor are, not to say cheaper, is quite compatible, okay, in this region. So it's more doable for manufacturing companies to open up here, okay, the contract manufacturing, this kind of things, okay. So because the cost will be more effective they do it here because we have a good infrastructure. Only the problem these few years we are seeing the government is not stable, as you understand, because there's changes, a lot of investment have more. Other than that, I don't see any issues on this. Moving forward, I think they're doing something to bring more on this. Actually, recently also before the pandemic, all these things, pandemic is also one of the reasons hitting it. You see some of the factories, Penang also, a lot of factories pull out from Penang at early stage during the pandemic. But I heard a lot of new companies is coming. Even my state in Negeri Sembilan, we have a big industries area also. There are big investment also coming in. So it's most on, I can see it's most on labor, still on labor incentive. Economics is more suitable to Malaysia at the moment. Although we are diversifying other things like talents and professionals, but at the moment it's there, I can say, for Malaysia.
Okay. Understood. What about you, Boon Yip? What is the ideal type of entrepreneurial business model for which Singapore is a more appropriate jurisdiction?
Okay, Singapore, first of all, leverage very much on international context. So the reason why Singapore is one of the popular countries to set up for entrepreneurs to set up their business or to come here to work. Reason being, first of all, it's an international field. So you have a lot of IHQ, international headquarters down in Singapore, banking hub, finance hub, things like that. So they are all happening in Singapore. So logistic-wise, it is still one of the logistic hub in Singapore. So you have all the transshipment happening in Singapore back in the British days. So it's nothing new. So what Singapore is doing is still leveraging on all these incentives and to further work on the branding on the international arena. So, but they have to work with partners like Singapore, work very closely with Malaysia, even for us. So the government actually encouraged us to work very closely with neighboring countries. Like recently, I think Singapore signed some agreement with Vietnam, right? Certain trades to Malaysia many years ago. What happened is now we see the international economy has been very different from before, very isolated, very divided. So Singapore and the region, I would say Asia Pacific or at least Southeast Asia would be very interesting in terms of coming to work together. So the model is like you set up the structure in Singapore and you would put all the activities outside Singapore, right? So, I mean, lately we have a lot like coming down from China. So what happens is Chinese is coming down out from, but setting up the base in Singapore, but they have to put the plant somewhere else. So that's where Malaysia, Vietnam, Indonesia, they are all equally important. Yeah, depending on your industry. So if you are doing mining industry, so probably you will end up in some eastern state in Malaysia or Indonesia, perhaps, right? So yes, if you're doing like what Ravi say, contract manufacturing, you end up in southern Malaysia or northern Malaysia could be, right? So these are the landscape that I see. Yeah.
Okay, so kind of summarize, Malaysia's well suited for someone who is on the manufacturing side because of course there's more space. The cost of getting things done is probably going to be a bit more attractive, and you have a well-educated workforce that is at a price that is not as high as, let's say, Singapore or Hong Kong, right? But Singapore is very tiny and very expensive, so. And it's also positioned itself as an international, at least a regional, but definitely an international hub. So it will be part of a wider strategic plan to, so you position yourself in Singapore, but you're taking advantage of the neighboring jurisdictions and so on, because Singapore has the banking, Singapore has the financial services infrastructure, so on and so forth. So, okay. Thank you very much, gentlemen. Appreciate your time. So for those who are not aware, please visit our website, hej.tax. We are part of Moores Rowland Asia Pacific, and Boon Yip is with the team in Singapore, Ravi's with the team in Malaysia, and we have offices across 18, 14 countries, so as far north as Tokyo and Beijing, all the way down to Sydney and Melbourne, across to India as well. So whatever you need, we probably the right place to start that conversation. Thank you very much. Have a good evening, and we'll see you next time. Bye-bye.